The US Federal Reserve has lowered interest rates by a quarter point, signalling further potential cuts in the coming months. For more, let's bring in David Scutt from StoneX. Was Donald Trump right?
Oh, look, that's still yet to be determined, but certainly he wants to get rates further out the curve that are very influential in the mortgage market lower. And on that score, he didn't really have much success last night. They actually finished a little bit higher on the day.
So let's start with the decision itself. Why did the Fed opt for a quarter point cut and then say there could be more to come?
Look, it really comes down to the labour market now, which is a bit strange because they've got what's called a dual mandate. So they're supposed to go and try and keep low and stable inflation and also full employment, which means basically unemployment where everyone who wants a job has one. And at the moment, that dual mandate is very, very lopsided towards the labour market side of the equation. They no longer see the labour market as being solid. They still think it's okay, but that's the area of concern. So what this is being framed as an insurance cut. So basically giving a little bit more stimulus to the economy to prevent a further deterioration in the labour market.
It's interesting, this had been priced in for quite some time. Everybody was expecting a cut. Do you think it could have or should have been more than a quarter point given the data that they're looking at?
Honestly, no, I don't think so. I think we saw a very similar reaction function to what we saw 12 months ago. There was some very, very weak data that came out in July and August for the US payrolls report, and the Fed started off with a 50. And then same again on this occasion, we saw weakness in the July and August reports this year. So the Fed has gone not a 50, but a 25 and signaled another 2 rate cuts based off the median dot plot over the remainder of this year. So to me, I don't think there's any need to go and get urgent. If you start delivering 50 basis point cuts and you start moving the cash rate or the Fed funds rate much lower than these current levels, it implies something is very wrong in the US economy. And just look at the retail sales report 24 hours ago, absolutely roaring the consumer. So at the moment, I think it's rightfully to be cautious and be meeting by meeting in the approach to setting policy.
It's so confusing, isn't it? Looking at these numbers, different numbers are telling you different things about the US economy.
It is, and it also reflects in the latest set of forecasts that were released by the Fed, because despite this concern about the labour market, they've actually gone and lowered their unemployment forecast based off the median projection over the next couple of years. And they also have a higher profile for inflation. So putting that together, along with stronger growth as well, which is expected over the next couple of years, it seems like the US economy is pretty good. If you stripped out the weakness that we're seeing in the recent payrolls reports, there is absolutely nothing in the data in the United States, in my opinion, to justify easing rates at all at this point in time. But they are very, very sensitive to any weakness in labour market data, and that's what they're prioritising right now.
Was this move broadly in line with market expectations, though? Was the market expecting a quarter, or did they think that there would be more? Did they think that there would be less in terms of talk about future cuts?
What they did was basically bang on expectations for this particular meeting. There had been a small risk of a 50 price in up until recently, but then that's been stripped back partly as a result of that retail sales report. Where they did go and differ a little bit is that they've gone and what's called brought forward the pace of easing. So markets had about 70 basis points of cuts priced in for this year. The Fed in the latest dot plot is signaling 75 basis points. So another 2 cuts following the one that we've just seen. But next year's where it gets very interesting. We've only got 1 cut in the Fed profile, whereas markets are looking for a lot more. They're expecting the Fed funds rate to go and basically fall beneath 3%. So implying another 100 basis point plus worth of cuts. So that's where there's a bit of difference at the moment. The Fed seems to be pretty cautious in cutting. The markets are trying to front run them and expect they're going to go and do a lot more work when it comes to cuts.
And a big one to watch. Let's have a listen to the Fed Chair Jerome Powell, the outgoing Fed Chair Jerome Powell, of course.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated.
All right, that sounds like a pointed barb at the White House, doesn't it? Talking about stable prices in particular and inflation, which we know that he has linked to tariffs and all of the economic policy that's come out of Trump's White House so far this year.
Yes, it's definitely feeding into the expectation that there will be a little bit upward pressure on when it comes to inflation in the future. But I've got to point out too that there's not been a lot of focus on this. I've got to say that there's been an upshift in services inflation in particular. Yes, there's been a bit of a pickup in goods prices, but it's been services categories that have really shown the strength, which you've got to go and back it out and say, well, what does that mean for the US economy? They're much more aligned with what's going on with supply and demand from a domestic side of the equation. And they're the ones that are picking up. So at this point in time, again, it doesn't really point to acute weakness in demand and activity, which again raises question marks about just how much further stimulus this economy needs, particularly when you've got a fiscal deficit still in the 6% region in the United States.
He's in a pretty tough place, though. I mean, the Fed in general, it's like a war zone with Lisa Cook there, Supreme Court getting involved. It's a pretty incredible situation. And obviously, as we know, Jerome Powell's time is up. Do you see there being any stability at the Fed anytime soon?
Well, that's going to be the really big kicker, and that will be the key determinant about what happens with the US rate trajectory and what happens with the US dollar and US equity markets as well. What's going to happen when Jerome Powell is basically has to go and retire in May next year? So will he go and remain on the board of governors, which he's entitled to do until the start of 2028? Traditionally, that's not what goes on when it comes to Fed chairs. And then who will replace him? Really interesting last night, Governor Christopher Waller is deemed to be a very leading candidate to go and replace Powell. But he didn't dissent. He voted for a 25 basis point cut. So he seems like a pretty safe pair and steady hands there at the FOMC. Will Trump go for someone like him? Or will Trump look to go and put someone else in, like a Stephen Moran, who's just recently been appointed to the governor's board, who wants to go and see 150 basis points worth of cuts over the remainder of just this year? That's going to be a really key factor. You're right, the turbulence, we don't know whether Lisa Cook has just sat in her last meeting. Of course, the Supreme Court will go and make that decision in the near future.
Yeah, I mean, you'd love to be a fly on the wall in some of those meetings, wouldn't you, to see the tension that would be happening in there right now and which direction it's going. How do you think Jerome Powell has handled things this year, given we've seen him touring a building zone of the Fed Reserve with President Trump, hard hats on and battle lines drawn? It's been a pretty tough place for Jerome Powell to be maintaining his own position despite calls from Trump to resign. Then the Lisa Cook side, you've got the stalking horse of Moran, as you mentioned as well. How's Jerome Powell going?
I think he's done very well. He must have a very thick skin. I think everyone can agree on that. He's taken a lot of flack and continues to do so. The one thing with Jerome Powell over time is that, yes, you could maybe go and say that he's been too sensitive to basically responding to weakness in labour market conditions and not really focusing on the inflation target. That's one area of criticism that I might go and label at him under his leadership. But realistically, he's setting policy for what he seems to be the outlook for the economy. And that's what you want to go and see from an independent central bank. So it's hard to fault him beyond maybe a little bit of criticism about actually getting inflation back to his mandated level.
All right, we've seen cuts in the US now. What happens to the rest of the world, the Bank of England, the RBA?
Very good question. And the question for Australia, we might get an answer to that later on today with the release of the August jobs report. What does it mean? I think that at the moment, the really acute downside risks in the US dollar have probably been mitigated a little bit, which might go and take some of that upward pressure off those other currencies, which does have an influence when it comes to imported inflation pressures. But realistically, I don't think it's got a lot of impetus right now. The biggest concern would be if the US economy fell into recession. And that would be something that would go and spark those other central banks into action. But when it comes to the RBA, the Bank of England, a lot of policy meetings right now are going to be set on domestic factors rather than international.
Does Australia face similar issues, though, in terms of jobs and the economy and inflation as what we're seeing in the US?
Absolutely. If you think back to the RBA's latest set of forecasts that were released in August, they were looking for basically a flat pancake for unemployment rate, 4.3% out to the end of 2027. Now, within a skerrick, a rounding error, we're almost at that level right now, which means that with 3 cuts already priced into their profile for what they're to keep their inflation at the midpoint of their target, it does not mean or does not take a lot for the unemployment rate to tick up to go and get the RBA into action. So keep a very close eye on that. Today, a 4.2% unemployment rate is expected, 22,000 jobs created. But if we see unemployment hit 4.3% or even go up to 4.4%, that would be likely a trigger to go and bring forward the pace of rate cuts. At this point in time, we've got one almost pricing for November. There is one fully priced by December this year.
All right, we'll leave it there for now, Mr. Scott. Talk soon. Thank you.
Great to be here. Take care.